Welcome to Subramani, and I'm going to talk a little about age and the importance of age in the equity broking or in equity investing. The desks today in India and in the US are run by younger people who have not seen. In the US, they have not seen the Fed tightening. Let's understand, 1980 to 2022 has been a 40-year or 42-year bull run, though of course last 3-4 months things have changed in the US bond market. I'm not talking about equity market yet. So which means these boys and girls have not seen what is the Fed tightening, how it happens, can it happen fast, can it happen slow. Even in India, anybody who has been in the market since 2003, 2003, think that every dip you should buy because the dip lasts a few days, maybe a few weeks, and then the market bounces back. So whether it was 2008, 2007, 2008, 2018, 19, 2020, March, right, all these bounce back was so quick that buy on dips was a fantastic piece of advice. So that has happened. Secondly, to be popular in the social media, you have to say keep investing, nothing will happen, nothing is wrong with you investing. Third, every asset gatherer, whether it's a mutual fund or their agents or their employees or bank employees, everybody has a vested interest in asset gathering. So very little advice will ever be given saying, oh, I think you should remove money from equities, markets are overpriced. That word is gone. Today everybody says, oh, if the market is down you should buy more, if the market is high, remember 10 years later you will not regret that you bought today, right? So right, wrong, I'm not getting into that communication. So which means today the market is full of people who don't even think that the market can come down, and the central banks all over the world, Fed or RBI, everybody behaves like these are kids, they have to be handled with gloves, velvet gloves perhaps, and so we should not let them suffer. So whenever there is a hint of a trouble, they keep throwing money at the market and saying, okay, here's the problem, solve it, right? So this is what has happened. We have been nicely mollycoddled into believing that we have tamed the tiger. So the tiger is now a pet animal. When you go into the deep forest and you see a tiger, you can pet it, nothing will happen. If it comes near your jeep, just go and pet it, nothing will happen to you, right? So it's not true. Equity markets are not like that. Equity markets are going to be troublesome. Now if you see what happened in the US, a 900-point rally followed by a 1,000-point fall, 1,000-point fall. How did this happen? Well, the Fed came and made some changes, and so immediately the market went up, which is very clearly short covering. People knew that the Fed would make some changes, and therefore the change had to be in the negative in the terms of interest rates had to go up. So when the interest rates went up, people said, now there is certainty, and therefore they rallied. The rally meant they were just covering their position. Now next day when people saw what the Fed had done, they came and sold. So a 900-point rally followed by a 1,000-point fall, right? So I'm not even getting into whether we are in a recession or things like that, but the markings are, markets are going to be volatile, perhaps more volatile, but markets have always been volatile, right? March 2020 market was volatile. 2021 market was just going up, it was not coming down. And again, the valuation of a Tesla or any of those companies, you can argue till the cows come home, but yes, all those things were a worry. Given Indian conditions, a couple of days back the Fed increased the repo rate by 40 basis points, and there again on that day I was lucky enough, when I heard about the meeting, I went and sold some of my banking and NBFC stuff. Luckily for me, yesterday the Axis Mutual Fund problem hit the market, and I could cover some of it at some substantially lower price. So yes, so that was luck. But having said that, so many people without much experience in the market, used to buying the dips, are now also asking, is the worst over? Is the market, will the market only go up from here? I have no clue. And I've understood that I don't understand, right? So that is one thing. And then Now people are asking, should we buy at every dip or should we sell at every bounce? Again, I don't have an answer for that, right? So after a very long time, the market has fallen so much, even in the US, right? Over like say 10-15 years, maybe once or twice is what it has happened. So the US market is not in great shape. There's not some great buying. The debt market is not likely to find very attractive, very many buyers at the higher end of the yield curve. At the lower end of the yield curve, people will stick in liquid funds, because one more interest rate hike and after that the US gilt might become more attractive. Is it scary? Yes, of course it's scary. I mean, everybody is scared, because see, people are scared because of two things. It's easy to say, you should keep buying and nothing will happen. That is true in the very, very long run. So if you are going to be investing for the next 10-15 years, that would be true. But what also happens is the immediate FOMO that, I could have sold and then bought back, right? All those feelings will keep coming. You cannot really forget those feelings. You cannot overcome those feelings. So to that extent, you have to be worried as to how you will react to a further fall in the market. So the first question is, are we done it? Is this all, or is there more coming? We really don't know. In the Fed also we don't know. In the RBI also we don't know. And thanks to this small skirmish in Axis, we don't know whether there are some fund related issues, or will it spread to other fund houses. Will it impact only small and mid cap, or will it impact the large cap also? Some of those managements itself will be suspect. Why did the company management give money to the fund manager to keep those funds in his portfolio? None of this will emerge so easily, right? So that is one thing, one more thing for us in India to worry about, right? So the chair, Powell, keeps saying that there will be soft landing, but the market may not be so sure about the soft landing, right? So if the market falls 2%, 3% in a day, people will be panicking, and traders will panic, and there is no doubt about that. And very few Fed meetings over the last few years have resulted in a downside for such a long time. And when I say long time, I mean 2-3 days of market fall is not something which many of the younger players are used to. And can one day make such a difference? The answer is yes, of course. One day can make such a difference, especially in small cap stocks. And the thing is, when the interest rate changes, everything gets impacted. So if you think that gold prices won't get affected, or crypto won't get affected, or real estate won't get affected, everything gets affected, and everything is in the turmoil. So if you want money, you don't know which market to go to, because every market looks like it is in the red. So you don't know whether it's a good time to be selling gold and buying equity, or selling equity, buying gold. You do not know what is going to happen to the dollar. When India changed interest rates, obviously the dollar strengthened. So if the dollar is the dollar really strengthening? Is the dollar really strong? You keep comparing it to the yen or the euro and think it is strong, but maybe they've also got weaker, right? So we don't know. I don't think the Fed is going to stop increasing interest rates. I don't think the RBI is going to stop changing interest rates, or at least tinkering the shorter end of the market, right? In the long run, of course, demand and supply will kick in. People will not put money in banks if it is going to pay 3% and 4%. So there will be corporates willing to borrow. So therefore, there will be bond issues. There will be mutual funds which will be launching schemes like income fund. None of them have too much of an AUM in income fund, so those schemes will get launched. So again, so the interest rate will slowly be accepted by the market. So all these things will happen, but all these things take time. So what exactly should one do? Every RBI governor or a Powell will keep saying, oh, don't worry, the market will always, we will always do a soft landing, we know what we are doing. But you don't really control internationally what will happen. You have no clue what will happen to the COVID scene in China, right? All those things are there. What should you do? Maybe continue your SIP, but make sure that you have a longish time frame in your head. You're going to be doing it for the next 5 years, 6 years, 8 years. then yes. If you're going to do it for the next 1 or 2 years because you need the money after 2 years, no, then it's a time maybe perhaps to do an SWP, or like I said earlier, sell on rallies, take the money and keep it home. Thank you.